This is the Friday, April 28th, 2017 version of the Market Plus segment. Joining us now is Tomm Pfitzenmaier. Tom, welcome back.
Thanks, Mike.
Now, I wanted to get a chance to discuss with you the cotton market. We saw two massive rallies in a row in that market. This week, a little bit of a setback. Could we just not breach that $80 point?
I think we can't breach it yet. Maybe when the April supply-demand supply-demand numbers come out, then maybe we can. I think the market, like you said, it's had a big jump up. We're banging up against that $80 resistance, and I think you're going to see some profit taking and some consolidation ahead of those supply numbers. If that comes out friendly and export, I mean, it's all down to cotton exports. If those continue to be strong, we may be able to nudge that out. And if we do, there's probably another nice little leg up in the cotton market. But that's kind of what it boils down to. I mean, we've planted probably all the cotton acres we're going to, so that part of it is it is what it is. You're not going to change that much from now on. So you're kind of down to how does that crop develop. And there are no major problems that I've heard of. Just
this cold weather is not expected to go all the way into cotton country.
Right. So that stuff is there's not much there one way or the other. I just think it boils down to those demand numbers.
Jeez. And so that export strength for cotton, we've been on a tear now for 6 weeks, probably or more, in the cotton market with exports.
The cotton market really for the last 2, 3, 4 years has swung, depending on what the Chinese demand was for our cotton. I mean, that's what it's boiled down to. They're the big gorilla in the room in cotton, just like they are in the soybean market. So right now, they've been buying quite a bit of cotton. If that ever changes, and I don't know what would make it change. Well, one of the problems is going to be that probably the cotton producers are going to overproduce like we have a tendency to do in everything else, and then that kills the market. But we're a ways away from that happening, I think.
All right. And so, yeah, it's more of a next year concern. If corn prices haven't rallied much and cotton's still around 80 cents, guys are going to make that decision.
Sure they are.
All right. Now, we do have a question here from one of our Twitter followers. This is from Glenn in Bryan, Ohio. He's on Twitter at Glenn, at Glenn_newcomer. We had the NFL draft pick this week, NFL draft, and he's asking you to compare the markets to the NFL draft. What is your first-round draft pick for market improvements? You were not very sunny on the program. Is there anything out there that could get you to come over to the bull side on these markets?
Well, it's really hard for me to make a case for the grain markets to do much. We're building world supplies. I think you have to set that aside and say that's not a possibility. Hog numbers continue to expand. We were talking in the break here. They're just building buildings all over the place. They're making decent money, and I think they're going to keep expanding. So the upside there is somewhat limited. We talked on the show some about the cattle market. That maybe has the potential for some fireworks here. I guess if you're talking about specifically on grain ag markets, I'd say that, or potentially cotton. You know, if we have a jump in the demand for cotton, those two are probably the ones that have the most upside. And then there's always maybe we do have this summer, it turns 100 degrees and never rains for a month and a half, and the grain markets are depressed, and I mean, that potential always exists every summer.
Okay. But you're saying, I mean, that's a pretty remote possibility. It's not one to build a marketing plan on, is how you're approaching this summer.
Right.
Okay. Now, I want to come back to the beef markets a little bit, because this has been incredible to watch all week. One of the things we've seen, you touched on the show, we've seen these weights come down. We've seen deferred orders of box beef, those 20-day plus orders, be the strongest, I think I read, since 2010. We're heading into grilling season. When do we expect this, historically, to begin to tail off?
Well, generally, this is somewhat counter-seasonal, the high we've had. So when you don't tail off when you're supposed to, it does kind of make you wonder what the potential here is here. If you're looking at smaller numbers, smaller cattle, a demand pickup potentially coming here. all the stars are sort of aligned all of a sudden for a pretty decent beef market.
Can you construct a scenario where we look at the 2014 172 live cattle prices? Is that in the cards?
I suppose under the right circumstances. I mean, yeah.
All right. You heard it here first. Tomm Pfitzenmaier says
That
cattle
wasn't
are
a
going to
projection.
172. That was a leading question.
That was.
But here's kind of my follow-up to it. We've seen over the past 3 weeks massive increases in open interest. There has been massive movement into the cattle contract by large speculators. Does that make you nervous when you see a rally like this that's really being driven by those large specs?
Yeah, I mean, the market this week to me had a blow-off feel to it, and that on Thursday and Friday. So that's why I'm a little hesitant to say we're going to go shooting up out of here after having that kind of a move up. It was like they had a lot of people stuck, and they kept them stuck right into the end of it. So I think we're going to have to wait and see how that shakes out next week, how the June contract reacts, whether this cash strength continues to hold here. If it does and June starts to move up, then we probably have some decent up move here.
Okay, need to see some confirmation.
Yeah,
before you get too excited.
I do. Yeah.
Okay. Now that being said, we do have this incredible discrepancy between cash and the June contract. Is it a lot harder to pull the trigger on hedging the June contract when it is that far below cash? Do producers generally want to hang on until we see a little bit more of a convergence?
You know, there's two ways of looking at that. You can look at it and say, wow, if you're going to maintain those kind of premiums of the cash market over your futures hedge, that's awesome.
Yeah.
But maybe that thing's already out as far as it's going to go, and you're going to see it collapse. So I guess the answer to your question is it makes it really hard to sell the June contract.
Okay.
Even if they're up at relatively high levels, even if they're profitable, like I talked about that decision-making matrix that you have to set up. Yeah, I don't know. That's what. Ideally, when you have upside potential like that, you probably want to use puts. The problem with puts is they're pretty expensive, even for puts that are quite a ways out, simply because people are going through that thought process going, I don't know if I want to be in the futures, but I want some protection, and so they tend to jack up the puts a little bit. So that's the
to find
trade-off.
an affordable put. We had the June contract close at 124 and change. Yeah. Would you have to go down to 115? I mean, get
probably 114,
114,
116. Yeah,
get
to get
substantially out of the money.
Yeah.
That's okay. Now, we did talk on the program. We saw a little bit of weakness in the U.S. dollar this week. We also saw weakness in the gold market. And I don't track the metals all that often. It doesn't seem like we see those two move in tandem very much.
Well, I mean, I think inflation fears have gone bad. It's kind of a risk-off trade in the gold, where they were buying gold over fear of who the heck knows what was going to happen with the administration. And now that that's kind of settled out a little bit, that's helped. And now all of a sudden you're in a situation too where with Brexit and with the French vote, you're seeing the central bankers and the Bank of Japan and the ECB have said, and they said this past week, that they're going to continue with their QE or whatever their program is. At the same time, there's a little unease about whether the Fed can raise interest rates as fast as they thought they were going to be able to. So you've seen a pretty nice sort of pullback on the dollar, which tends to be supportive to our ag exports. Although when the dollar shot up, I didn't see us drop off that much either. So I'm not sure how well correlated those two are right now. But yeah, gold may correct a little bit more. There's a certain crowd that likes to buy gold, and I think they're going to keep it well supported because there's all this concern about geopolitical risk and U.S. administration risk with taxes and all that.
North Korea, the nuclear missile, you know, I mean, the amount
all
of
that.
Yeah, Armageddon talk out there is more than I've seen in my lifetime, which, yeah, probably would help support the gold market.
Correct.
One of the things we didn't get a chance to talk about that just occurred to me, the Brazilian real. Is it continuing to find some strength? Are we getting more competitive versus Brazil?
Actually, we watched that pretty closely, and it hasn't really changed in the last 6 weeks. I mean, it's kind of bounces between 31 to 31.2 to 32, and it just kind of stays in that trading range, and it really hasn't reacted much.
All right. Well, Tom, before we let you go, we have been asking for questions from ag students around the country, and we encourage all of you, if you are an ag student, either at a university or at the high school level, and you've got a question you'd like to ask our analysts, get out your cell phone, shoot a little video. This week, we are featuring a question from an Iowa State student, and learn more about this project by going to the M2M podcast number 143. Anyway, here is the 4th installment of our college-level agricultural student question.
What's the biggest hurdle for someone starting out?
Short and sweet, Tomm Pfitzenmaier, and let's talk about trading.
Yeah, I guess that's about the only thing I can really assess, because there's a lot of hurdles about anything you want to start out and do. In terms, I guess knowledge is the most important thing, and I think that's followed up pretty quickly by having the right mental attitude, because you talk to anybody that's traded much or been involved with the markets, or any farmer that has to market grain, and the mental aspects of that are really, really difficult. So you've got to structure yourself in ways that you can deal with the stress that comes along with that. Now, until you've done it a little bit, it's hard to know where those sort of pressure points are going to hit you. But I think it's something you have to be prepared for. You have to put some thought into. You're probably best to ease your way into it. Maybe buy puts, maybe buy a call where you have a defined risk, and sort of work your way into it that way. You know, charging right into a futures contract, maybe I mean, there's certain people that they have no problem with that, but you just need to sort of assess where your head's at in terms of your ability to bear risk and stick with things when, and I mean stick with things when they go bad. When they go right, that's easy.
Yes.
You know, anybody can do that.
Yeah, yeah. All right. Well, I hope that helps, and thank you, Tom, so much for taking the time to join us this week. Really appreciate it.
Thanks, Mike.
And please join us next week when Walt Hackney and Elaine Cubb will sit across from me at the market-to-market table, and we'll explore how heritage breed farmers are producing pork with a purpose. Until then, thanks for watching or listening. I'm Mike Pearson. Have a great week.